Hello, my name is J.P. Pontbriand, Chief Investment Officer for Salem Five Wealth Management and Trust. When people hear fixed income or bonds, they usually think safe and boring. But right now, fixed income is anything but boring, and it's becoming an increasingly important part of both conservative portfolios and diversified ones. In this video, I'll walk through three key things shaping bond investing today. First, U.S. Treasuries and what's happening at the Federal Reserve. Second, credit spreads for bonds issued by corporations. And third, opportunities in foreign bonds. Each of these topics could be explored in great depth, but today we're simply providing a few basic but important insights. Let's start with U.S. Treasuries, the foundation of the bond market. Issued by the U.S. government, Treasuries are considered the safest bonds in the world, so everything else is priced relative to them. After a second round of short-term interest rate cuts by the Federal Reserve last year, we now have a more normally shaped yield curve, meaning that investors earn more interest rather than less for committing to longer maturities. This is what we usually see in an economy that's experiencing or expected to experience healthy growth. And overall, Treasury rates from short-term to long-term are within historically normal ranges. So what comes next? The nomination of Kevin Warsh to succeed Jerome Powell as the chair of the Federal Reserve is likely to be confirmed by the Senate. We expect little, if any, rate change policy at the Fed. Our key takeaway for investors is to move away from low-rate, short-term instruments and toward higher rate options. Now, let's talk about credit spreads. A credit spread is the extra yield you earn for taking risk beyond Treasuries when lending to corporations instead of the U.S. government. Right now, those spreads are tight. That means investors are not being paid much extra to take on credit risk. Think of it this way. If Treasuries yield about 4% and a corporate bond pays about 4.8%, then you're getting less than 1% extra for the possibility that the company might run into trouble. Adjusting for income taxes, a Massachusetts taxpayer earns less than 0.5% more. That's not necessarily a bad trade-off, but it means we have to be particularly selective in this area because the margin of safety the extra yield provides is less than normal. Our key takeaway for investors is to limit corporate bond exposure, particularly high-yield bonds associated with lower quality issuers. Finally, foreign bonds. Most of the bond market, over 60%, lies outside the U.S. Many opportunities exist within both developed and emerging market countries. These can include high-quality bonds with greater currency-adjusted yields than comparable U.S. bonds, diversification from U.S. economy and Federal Reserve policy, and selective foreign currency exposure. Yet this area is almost completely ignored by U.S. investors. Like any investment, foreign bonds also have their particular risks and complexities. Nevertheless, it can be a huge blind spot that merits consideration, especially with the U.S. dollar's recent volatility and weakening. Our key takeaway here is that foreign bonds should be a meaningful part of the fixed income portfolio for many investors. So, are bonds still boring? Maybe, but they definitely are too important to neglect and too varied to be treated as a monolith. Here are our top priorities overall for investors to consider. 1. Short-term rates are not very compelling. More attractive rates are found in longer-term instruments. 2. The extra yield in lower quality bonds is relatively low, so exposure to these types of securities should be limited. And 3. Foreign bonds are worth a look and probably merit a greater allocation among fixed income holdings. Thank you for watching. We hope today's look at fixed income helps you with your investment portfolio. Please reach out to your Salem 5 Wealth Advisor for more information or with any questions you may have.